want to talk to owner-occupiers today, so either budding owner-occupiers, so someone who wants to maybe buy their first house or buy their own house over the next kind of 6-12 months, and also someone who has a current loan and is thinking, should I refinance, kind of what are my options, when are my options going to be best. Now, I'm going into this assuming that we will see a decrease in the market, which has pretty much been called by everyone. And I think you'd be a little bit crazy if you looked at the market from the start of the year with like what's happening with COVID. I think you'd be a little bit naive to think that the market wouldn't be going down a little bit, at least, probably more by a reasonable sort of margin. I'm going to assume, just for the figures that I'm putting up here, that let's say the market fell by 25%. Just so that we can look at, okay, well, what would be the kind of fallout of that, and what does that mean the market falls by 25%? So what I'll start off with is I'll assume the average property is $1 million in Australia. It's probably way too high, obviously, but for ease of numbers, that's what I'm going to use. So let's say we have a 25% drop between now and kind of when the market bottoms out. And eventually we start going back up. So making a couple of assumptions there. So let's say the bottom of the market hits in, let's say 6 months, 9 months, 12 months time sort of thing. So this represents a 25% decrease on the market overall. Now, if the market decreases by 25%, what's kind of the makeup of the individual homes? Because the market is made up of all these individual transactions, these individual assets called a house. And are they all decreasing at 25%? Well, actually, no. Different markets will decrease at different amounts, different property types, and the makeup of different suburbs will push prices differently as well. So it's, yes, very much to do with supply and demand. One of the sorts of properties that will probably get hit hard are niche properties. So niche properties, quite often niche properties are like investor driven. So investors like niche properties like studio apartments or dual occupancy properties, those sort of things. So properties that lenders are generally giving money or less likely to lend against, you can kind of assume they're the niche properties, and lenders are less likely to give you money for them because they're niche, and in times of trouble will be harder to resell, or even in good times will be harder to resell. So let's assume the average niche property is $1 million. Well, probably not the case, but niche could include as well luxury properties, waterfront properties, those sort of things as well would be included, because we've got a much smaller target market for those sort of properties. So let's say they drop from 1 million down to, let's say, 600K, and then they kind of come back later. So this market is going to be made up of some of these sort of properties. It's also going to be made up of some sort of properties that maybe owner-occupier property areas with low debt, people who are happy to ride this out and just see this as a blip, and they still want their house, they want their kids to go to the local school, or they want to live in the area, or they don't have a home loan, so they're not even really thinking about this kind of short-term issues. Let's assume the median price for everything is $1 million. And so let's say, I don't know, their prices go down, I don't know, let's say 850. Let's say they go down 15%, then go back up, because they're less likely to sell, they don't need to sell as easily. They're just going to kind of ride it out. There's going to be less forced sort of sales. So that's kind of our look of a suburb that might not be hit as bad potentially. You might have an area with young families and high debt. So here, let's say average is $1 million again, and that's probably going to drop a little bit further because you're going to have a higher makeup of mortgage, like forced sales and that sort of thing as well. And let's say that goes down to 650K and then goes back up. So depending on the area that you're looking at, you'll probably see a variance in price drops and the type of well. And certainly if you are, which is pretty much the same area as this, but if you're looking in areas where there are more mortgagee sales, so the bank's selling the property and they say, hey, we just need to sell it for the best price you can. We can't keep it, we don't want to keep it, we just need it sold. Those sort of areas are probably going to get fairly harshly hit as well. Now, sometimes mortgagee sales actually do really well. Mortgagee sales can sometimes have the effect in a reasonable market of drawing in extra attention. It's like a real estate agent saying, hey, I think the property's worth $1 million, but I'm going to advertise it at 800 to get kind of extra competition. Very much not the right thing to do, and agents can't really do it. But in terms of a mortgagee sale, with a market that's strong or rising, it means that you're probably going to get a lot of interest. Now, if the market's made up of a lot of mortgagee sales, we're not going to see that same kind of effect. And generally speaking, you're not getting that sort of effect anyway. But mortgagee sales are probably going to be a fairly good kind of ticket item. Obviously, extremely sad circumstances around the fact that we will see a pretty big increase in mortgagee sales. But certainly from a buyer's perspective, that's probably where we're going to see house prices return to something that's, to be honest, probably a little bit more normal than where prices have been in sort of recent times. Anyway, that's kind of just a bit of my thoughts. Really just thinking about, hey, if you've got a property at the moment and you're going to be writing this out, so you live in this group here, and your loan is 800 or around about there, you don't want to be refinancing there. You want to be refinancing as early as possible. So, hey, let's get those valuations in case they drop over the next 6 months. Can't see valuations increasing over the next 6 months. Obviously, never say never. I don't have a crystal ball or anything like that, but I think it's extremely unlikely. And if you're looking at buying a property, look at those kind of the niche properties, mortgagee sales, those areas where properties might drop further, or those areas that are in lower demand. So if there's a high supply of housing and it's kind of a lower sort of demand area, and it's so easy to kind of find these statistics. I mean, you can see if a property's niche just by looking at it. If it's small, if the bank tells you they don't like those sort of properties, that sort of thing, you're like, okay, that's a niche property. But in terms of areas where there's a lower demand, I mean, even realestate.com and those kind of places, it'll show you that box with all the people, and this amount of people are kind of looking at each property like 1,200, so it's a high demand, or 300, so it's low demand, that sort of thing. That can give you a pretty good indication as well as to if it's a high or low demand area as well. So there's a lot of tools out there. Don't kind of just rush in or jump in like a crazy person. Sit back and think about it, and think about, okay, well, what's going to happen in the kind of next 20 years. Anyway, there's some quick, brief thoughts of mine on what we're probably seeing in the market at the moment. Thank you.